All right. Hello, everyone. Welcome to Bits and Bips, exploring how crypto and macro collide one basis point at a time. So today we've got some rather spicy and interesting topics, but we're supposed to pretend to do things in order rather than live in total chaos, so we're going to do some intros. I'm Austin Campbell, high scholar of Zero Knowledge Group, self-described and recovering grouchy fixed income trader, and professor at NYU Stern. Joining me today are my two co-hosts, Chris Perkins, the golden hand of Coin Fund, who has promised us that prior to Thanksgiving, he's going to let loose on some topics and then drop the mic, and Ram, Maester of Wealth, leader of Lumina, who's going to bring us macro and markets perspective and may or may not be able to successfully show us a chart. We'll find out. No guests today because the three of us have more than enough that we intend to talk about and far too little time to get that done. But we will continue to have some excellent guests going forward. Before we start, remember that nothing we say here is investment advice, and that as general advice, don't take investment advice solely from podcasts. Check unchainedcrypto.com, bits and bips, for more disclosures. So guys, let's start with a little bit of market discussion today in a section I'm going to title in our working notes, Detour or Death Trap. So the market's been a little bit volatile. Bitcoin prices fell to 82K before rebounding to the mid to high 80s throughout the day today. Alts in many cases have been hit much harder than that. So where does this leave us? On the crypto side, the Coinbase premium may be back to positive. The cryptocurrency complex hit an all-time daily high for volume with the CME. There have been some minor improvements in dollar liquidity, according to Arthur Hayes. He says QT stops December 1st. Wednesday will probably be the last fall, and U.S. banks increased lending in November. Jeff Park has noted that we're relatively bullish. We're finally done with long leverage trying to catch the knife. Open interest has come back to the short side, and this is a welcome reset if we can confirm IBIT inflows, which was today. If we zoom out and look at markets more generally, President Trump has accepted an invitation to visit Beijing next April. He invited President Xi to the U.S. for a state visit later that year. The market is now repricing at a 75% chance of a 25 bip cut at the December 9th to 10th FOMC meeting. And New York Fed President John Williams has signaled a policy shift, citing rising job risks and cooling inflation. So I'm curious what you guys are making of the backdrop. Ram, let's start with you and see what you have to say.
Yeah, look, overall, you've had market volatility starting with when the Fed had the hawkish cut. That was one. And then two, you had Michael Burry shutter his hedge fund with a broadside critique of the data center theme and round trip trades. At where you are now, though, is that the market's now pricing in an 80% probability of rate cuts for December. That was due to comments from Fed Governor Waller this Friday. The markets have rallied. You also had elevated volatility in the VIX, which hit 26. That's usually the kind of lower bound when you start to see a rally. So I think you're in good shape. I think we rallied now through year end and feel pretty good about that. I think on digital assets and Bitcoin specifically, I call this a Nick Carter rally. I think Nick Carter said I'm buying Bitcoins. This is the Nick Carter rally. This is a KOL Nick Carter rally. So Nick, this is for you. But I do think the rally is ultimately sold. I think maybe it's a multi-week rally. You just kind of have to reassess. I don't think you get to new highs in the next 1 to 2 months per se, but I think it's risk on. We'll have retail sales report tomorrow. I expect that that'll be strong. And you see a lot of conciliatory messaging from the White House on almost like every dimension. So it's really been a change of tone ever since the elections. So, overall, this is constructive. I still view this as like a Goldilocks macro setup. You just had a negative sentiment from headlines that weren't reflected in earnings. And earnings are strong, continues to be strong, and there is ROI on the data center spend. We'll talk more about that when we get to Nvidia.
Yeah, maybe I'll chime in. And I think one thing that I've noticed is that retail is exhausted. They got hammered on 1010. They're still getting over that. And then they got this whammy last week, a little bit before that, to your point, Rom, where they're like, wait a second, the Fed might not cut in December. And it seems like rates have been in the driver's seat. It's kind of concerning as crypto natives, where we're like, gosh, this really, really centralized thing controlled by a handful of governors is really driving all of our asset classes. We're trying to deliver this decentralized finance thing, and that's all that matters. The good news for markets, though, is that Polymarket right now is pricing 83% chance of a 25 basis point cut. You mentioned, Austin, the futures volumes that we're seeing. That's great news if you're one of the 4 tokens that are covered by CME futures. The one thing I think that's still really hurting these markets, and I talk about it over and over again, is the lack of alt futures beyond those 4. We just don't have that comprehensive liquidity. It's been that liquidity is forced offshore, where you're still subject to the ADL, the counterparty risk challenges, and so that's bad. Last thing I'll say is that against this backdrop, retail has been hurt. They're going to come back eventually, but there's this bigger flippening I continue to see, and that's the institutions slowly, methodically marching forward as retail does what retail does and goes for the next hot ball of money. I don't have major things to report, just things that I see in the market. I'll give you an example. We have a business that we launched the risk-free rate of Ethereum, very much fixed income foundational product that's very institutional in nature. And I'll tell you, the last day signed 3 major contracts of major institutions as they methodically march forward. And that's just an aside, an anecdote. But I guess my point is that institutions, every day they move more methodically forward. Retail comes, retail goes. Fed's in the driver's seat. One last thing that I'm concerned about, frankly, we saw Nvidia earnings. They did pretty well. I'm kind of concerned what happens if they miss earnings in the future. And I think even Jensen mentioned that could result in some challenges. The other risk out there is you hear this news here and again around quantum. It's coming. It's almost like the Y2K thing that's out there that no one really knows it's going to happen. We know it's coming. And the last thing that I'm a little bit concerned about, and Rob, I'd love your perspective, is on JGB yields, right? They remain elevated. And we saw a surprise rise in Japanese rates that really surprised markets a few months back, really hurt asset prices because there's this concern around deleveraging of what's known as the yen carry trade. We're still seeing them elevated. And then finally, liquidity has been pretty tight. And what we're seeing now, at least, is that QT is coming to an end December 1st. So at the end of the day, all those risks and benefits, I'm kind of in Rom's corner. I think long term, I wouldn't be here if I wasn't super bullish. I think near term, the setup is very constructive.
Well, I'll hop in and then we can get to the GGB yield point. One, I think, Chris, what you're saying about institutions coming in also has major implications for the crypto complex as to how we think about prices going forward, right? If you rewind 2 years ago, 4 years ago, we didn't have to think about what are the differential opinions of the average crypto person versus, call it, people in their 401k funds or pension funds so much when we were thinking about Bitcoin versus alts or rotation between tokens, because everybody could buy everything. But realistically speaking, for a lot of the institutional buyers, like you said, if there's not CME futures or some sort of listed equity product, a lot of them are just not going to touch the thing, right? I don't think there's a lot of institutional buyers of many of these project tokens, many of the smaller blockchains, many of the more subscale projects in this space. And so as we're looking at price action, I will remind everybody that Bitcoin going down to the mid to high 80s is still up significantly from the election. But there are a lot of alts that have performed significantly worse over that same time frame. And I think that might have to do with the growing divergence between the buyer pools. Because if you go look at people who are the holders of Bitcoin now, and if they own any other crypto and would identify themselves as traditional financial investors versus, say, the holders of, let's pick something not even too far off the beaten path, say, the SWI token, you probably have a very different investor profile just between those two pools, much more than we have in the past. Ron, what do you make of that? What would you expect?
Yeah, no, I agree with your observations. Digital assets like Bitcoin have a bid. There's an emerging thesis around international money with major institutions behind it. Altcoins, I'm not sure you can trust their fair value. The depth of the order book is limited. You have to be highly selective. A strategy that's long top three and short the rest probably does well on average. I think I'd be very suspicious and skeptical of the vast majority. This is not a controversial statement, I think, for us, but I don't think people appreciate that. You stick to quality, stick to liquidity. Just on the JGBs, I put this in from a medium and longer term perspective, this doesn't really mean much. It's just a nothing burger. This is a phrase that you hear me say often. This is another one. This is just another nothing. So the good news is I'll talk like big picture and then tactically. Big picture, what matters is earnings, a pattern of disinflation, constructive regulatory policy, consumer spending, the government still spending. All that's going in the right direction. You have record beats, strong earnings growth. That's the big picture. Like every single cylinder is working here. The rest around is just news and sentiment. Sam Altman says something stupid to Brad Gerstner about $1 trillion in unfunded liabilities. Michael Burry comes out, shutters his fund, takes a broadside attack. Like that's just news. So on JGBs, tactically, the good thing is that the US dollar has been through an extraordinary rally. If you look at the last 3 months, like so much for the dollar debasement trade. There's no dollar. The dollar is strengthening. The reason why that matters is that the yen carry trade is funded by borrowing in Japanese yen. So the risk is that if rates go up, your carry costs go higher, but your liabilities are actually dropping net due to the decline of the yen versus the US dollar. So it's nothing burger.
There you go. But strong dollar oftentimes leads to weaker commodity prices. That's the other side, right? So, that has impacted, I think, in price action in certain cases. On the alt point, I agree. Fundamentals matter. They're not always in the front seat. As we've seen recently, very, very constructive long-term fundamentals for certain projects. And I think you'll see that differentiation. And then, of course, like I'll keep continue to say it, like institutions can't touch it. Even the DAT, like the DAT is an amazing wrapper because, it's just you just go into your brokerage account or your institutional OMS and you buy another one. But it's very hard if it's a super volatile asset, particularly going into year end where you don't want to see a drawdown because you've had a great year. That's part of the issue.
I will echo Ram on the dollar. I guess we can call it rebasement trade. I don't know how we want to name that one, though. I do want to counter one point on the bright economic news. So banks are still sitting on $395 billion of unrealized losses, and I think people don't understand what that will do to credit creation. Liquidity looks better than it is when that is going on because banks are going to be holding a lot of reserves. Everybody will say, oh, they've got a lot of dry powder for lending. But in many cases, like a good one to look at that had large losses in the held to maturity bond book is Bank of America, right? They're going to be sitting on a lot of cash, not to go lend that out to people, but just so that they have a strong balance sheet so that people aren't going to come run the bank as happened to Silicon Valley Bank. And that sort of grind takes time, and the inability of the administration and like the Fed to get rates significantly lower, especially once you get outside the short end of the curve, has an impact on that. So one thing I would say in addition to, I agree with the comments on QT and that coming to an end will be moderately helpful along with Treasury starting to spend again. But I think there's more work to be done from the credit perspective. And the other thing we're seeing on that front is like very low mortgage origination, right? Like you have a lot of people locked in compared to historical norms and like not a lot of activity on that front. So when we're thinking about retail, when we're thinking about the general market, sort of like, Ram, I guess this plays in with your nothing ever happens meme sort of like thinking here. I've been saying for a long time, things are not nearly as good as the optimists would like and not nearly as bad as the pessimists would say. And we're sort of grinding along at mediocre on a lot of these measures.
I'm more on the optimist. I'm more optimistic than that. The only thing that is holding people back for recognizing just how things good are, while acknowledging, yes, you have a K-shaped economy. Yes, of course. That's legitimate. Been the case for decades. It's true. The only thing holding people back is the fact that asset prices aren't where they want them to be. But if they were, I wouldn't be as excited. So this is the going's pretty good. You're supposed to buy when Nvidia's got a forward P of like 26 times earnings with 66% year-over-year revenue growth, and Meta's at 20 times earnings with 40% year-over-year earnings growth. That seems like a compelling investment backdrop.
Well,
let me jump on your bank point, because we know a little bit about banks, and I don't think it's a surprise that you're seeing the Basel Committee now lightening up a little bit, particularly when it comes to crypto. They don't just do that without pretty strong feedback from people like Governor Bowman and others. That's the other liquidity unlock that you could see, as the U.S. really starts having a more outsized role, and really, like, Secretary Bessent's a smart guy. He gets how this all works, and the other liquidity toggle they have is bank regulatory capital, and I do think that's trending very positive for the banks, which could help to facilitate, some of that unlock that you're suggesting. Do you agree?
So I agree if they do it. My worry is that the Basel Committee is like a glacial entity, right? Like, them starting to work on it means 5 years from now we'll have an
Of course.
answer. But the interesting part, Chris, and I don't know how the coordination is going to work, is do the U.S. banking regulators just go rogue on that and impose some other treatment?
That's my point. I think the U.S. regulators are starting to say, well, wait a second. I have a lot, especially Treasury. I have a lot more to say with the front end of the curve with these things called stable coins now. That's awesome. Why am I letting the Europeans set Basel rules? No, I know what's best for my banks and for our economy. And, it's an America first regime. So I don't know. I feel like that's something that they're much more attuned to in my recent discussions. And, just seeing that data point where the Basel guys are walking back some of the things that they're walking back, I thought that was super interesting.
Yeah. Sorry, go ahead, Ram.
I'll be brief, but look, I think the banks were in good shape. Credit growth is 4.4% year over year. That's great from a GDP perspective. Access to credit's good. Credit quality is good. Credit performance is good. Delinquencies are low across the major banks. There's no credit health issues. We're 3 to 4 years into digesting commercial real estate issues, which are more and more in the rearview mirror. The other part, fun fact, there's an ETF called, you guys will appreciate this, GSIB, GSIB. Okay, these are all the SIFI too big to fail banks. That ETF is outperforming Bitcoin. This is funny because think about the origin story of Bitcoin, which Satoshi Nakamoto wrote in the Genesis block. He made a comment referencing, no bank bailouts, right? GSIB is up, not 10, not 20, not 30, 45% year over year, 45%. So banking sector is good. It matters because it's the bedrock of the economy.
No, I agree with that one. And okay, so on the note of the bedrock of the economy, let's talk about the other thing for a moment, Ram, since you brought this one up. Nvidia. So Nvidia earnings were not bad, to say the least. And yet after they beat, the stock fell 3.2% after an initial pop. Valuation concerns seem to be dominating the news headlines and the timeline. I guess the optimistic take is that this is a healthy correction. The skeptical take is this is the start of an unwind. Ram, you mentioned Meta earlier. They're down 21%. Microsoft is down like low double digits as well. CoreWeave is down nearly 50% in November. Semis in general are down about 11% in November, their worst month since 2022. What are you making of all of that? Like, is that a buying opportunity for people or the start of something worse?
Yes, no, it's a buying opportunity. This is what you should be buying on Black Friday. This is what you buy. We had a high beta crowded positioning unwind. That's what happened. That's the simple variable to understand what happened. If it was a popular consensus name and a high beta, and especially if it was in like the data center theme, then it sold off. Pick anything that met that category. It's not so much stock specific. It's just crowded positioning got unwound. A lot of retail investors were hitting sell. They ran for the exit. I think that's behind us. Asset prices are responding as they should if you have the lows in place. The Nvidia earnings were better than just strong. They were outstanding. They were shockingly good. I say this as a mild-mannered individual. Like I'm rarely ever hyperbolic. They had an acceleration in their quarter-over-quarter growth versus last year's same quarter-over-quarter. They continue to sell out every GPU that happens. They maintain pricing power. They can pick and choose their price points. They control their gross margin. They have visibility through most of 2026. When we get through 2026, they'll have visibility through most of 2027. They've had a beat raise every quarter since ChatGPT. That's because they know how to manage Wall Street expectations. There's 1,200 data centers globally if you look at just the hyperscalers. And most of those are CPU, old school data centers. There's a build out of new data centers that are GPU native. And we're only in the early innings of this. Now you've got the Trump admin enabling Saudi Arabia to go build out potentially up to 60 data centers. That'll be full with NVIDIA chips. So, yeah, I mean, the earnings and the revenue was it was strong and outstanding. That said, I'm actually only benchmark weight NVIDIA. I'm not actually overweighted because, positioning can get in the way when it's crowded around a good opportunity. I think it'll do fine now, but I'd rather own, Meta. I'd rather own some cruise line stocks and other things.
And then on top of that, Ram, it looks like Trump just accepted a state visit to China, and China will do the same. So I feel like that's probably a green shoot as well. But I guess here's my question for you: what are people going to be talking about at Thanksgiving? Nvidia or crypto?
The Mamdani White House visit? I mean, that's one.
Yeah, maybe. I don't know.
What's up with that one? What's up with that? I mean, that's one. Let's see. They're going to talk about, we're going to have that meme about the guy in the attic who's talking about Bitcoin, right? That meme's going to be back this year. Last year was the opposite. That was the victory lap meme, right? What else are they going to talk about next week? I'd put it back to you guys.
Probably they're going to talk about the G-sub ETF now that you mentioned it.
Look, I think banks are just so well positioned. Almost any dimension you look at. Yeah.
So stable coins aren't going to be their death. I mean, I spoke to my buddies who literally run the G-SIBs, and they were like, bank deposits, these stable coin things are going to kill me. But that's really, gosh, just like money markets, not the case. They're doing just fine, aren't they, Austin?
Banks are doing just fine. Though I would say if banks have killed themselves in some way here, are going to get killed by stable coins, I don't think what's the right way to say this? I think that banks may have dramatically overplayed their hand on the policy frontier in a way that's going to have reverberations people don't expect, which is to say the gloves came off and it was like naked self-interest with trying to ban yield on stable coins, and people know that. And the reason for that is, this is the advantage. I'm a business school professor. I literally teach this stuff. In the 1933 Banking Act, there was a thing called Reg Q, and Chris probably knows what Reg Q was, but for people who do not, that was the ban on paying interest or yield by banks. And what happened is that in the 70s and 80s made them uncompetitive products, and they had to get rid of that restriction because it was crippling their ability to gather deposits. And now banks who had that restriction taken off have gone and argued, well, you should restrict somebody else with a thing that we just argued 2 decades ago were things that made us uncompetitive and had you get rid of so that we could go do the exact thing that we're having you ban somebody else from doing. I have been hearing things coming out of DC that are totally different on banks than I've heard my entire lifetime. Let me just throw something out there that I think may now be inside the Overton window. How about the repeal of Graham Leach Bliley?
I'm all for that, by the way. I'm all for that. Bring it. Let's do this. Yeah, look, I think you can offer consumers more value if you have integrated offerings and services. One-stop shop makes a lot of sense for banking, insurance, wealth management. So I think that's a great idea. Now, banks are under pressure from stable coins, but it's community banks and some of the regional banks. And it's going to take time for this all to play out. And the last point here, stable coins, they created a bid for the US dollar too. So Bessent nailed the stable coin. Like, kudos to Scott Bessent. Like, did the right thing. I think the mortgage move, 30-year mortgage, right idea also. Go ahead, Austin.
I will argue against you on the 50-year mortgage one. I actually think that's a bad move. The longer you extend duration, right, for people, and the longer we take the timeline like out to both buy houses and pay off mortgages, one, the more duration risk you're putting into the economy in a way that's going to be hard for people to hedge. Like, somebody's got to own that duration if we want to extend that. So that's problem number one. Problem number two, I'm like skeptical of many forms of credit creation from an affordability standpoint, because the core problem is supply. If we don't build more houses, but we continue to subsidize demand, subsidize demand, subsidize demand, subsidize demand, all you're doing is causing inflation. Like, that's not to anybody's benefit. We're just inflating house prices for boomers. And the reality is young people still can't buy anything. Prices will still be going up. We need to build more stuff if you want to solve the affordability problem.
Just a brief response to that. Focusing on the U.S. consumer, if you've got a 50-year mortgage and your average mortgage holding period is 7 years, that creates value. So the duration risk is really, and what you were getting at, is someone in the capital markets. It's not on that consumer is going to be able to have more disposable income from that 50-year duration. And it's one of the few times that the consumer can borrow as low as, and sometimes lower, depending on how you time it, than the U.S. government. It's one of the few times. So if you can let them take advantage of that opportunity and the ability to refi, it's a good opportunity. So
my trade-off though, Ram, is I worry about it breaking the mortgage complex, right? Like, as somebody who's been on the other side of that trade and seen people owning MBS, or like owned many billions of MBS in one portfolio, I'm going to ask a hell of a lot more for a 50-year, right? Because the problem with that 7-year holding period is I get delivered the worst stuff, right? The stuff that stays is the stuff I don't want, because rates went up and people are not refiing. And when rates go down, people refi on me. And the impact of that is even greater with a 50-year. Like, I actually think, counterintuitive, but I think there's a very good chance that 50-year mortgages raise mortgage rates, not lower them.
It's a great point. It's a great point. Yeah, you have the term spread. I mean, look, it's a markets risk management function to resolve that issue and see where prices land. Having an additional option to borrow expands the opportunity set for a borrower, though, right? So
we should not give that without forcing people to build more houses. Like, the real trick would be to have the federal government like make the Fannie, Freddie, Ginnie guarantees on 50-year mortgages contingent on building housing, so that if California wants to continue not to build anything forever, they just can't participate.
Yeah, we got a problem with Brian Johnson too, right? Mortgage comes from the Latin word mort, which means death, right? So it's supposed to be the debt that stays with you your entire life. People are living longer. Just wanted to throw that into the mix as well.
All right. So before we get too further off track on turning this into a housing podcast, let me talk about some other forms of financial management. Let's talk MicroStrategy and DATs. So MSCI might remove MicroStrategy on January 15th because its BTC holdings are something around 75 to 80% of its assets, certainly above the 50% threshold that they're now saying would reclassify things as a fund, not an operating company. This is going to trigger many billions of forced selling from passive index funds. And to remind everybody, passive index funds just look at the list of things in an index and buy them, right? This is not a discretionary thing. They just follow the list. So that breaks this reflexivity route. MSTR's MNAV premium is now down to like barely positive, if positive, from like literally 3x at some points. And so this thing just kind of trades like a closed-end Bitcoin fund after that. Saylor obviously disagrees with this. He said, we're an operating company, not a fund, citing the 500 million software business. He says they have 7.7 billion in digital credit deals as proof of, quote, active structuring, and argues that they're a unique Bitcoin-backed finance company, not a passive Bitcoin holder. I'm going to pause there before we talk about DATs further. What do you guys specifically think about the MicroStrategy thing and the index inclusion?
From a price perspective, or what?
One,
I guess, yeah.
price, and two, like, do you think MSCI is doing the right thing excluding them?
Yeah, that second one, I don't know how to answer that one, but yeah, and the first one, I think it's probably old news and it's probably history. And usually when you see these announcements, the worst has already impacted the asset. So everyone knows this now. It's a highly covered asset. The news is socialized.
Chris, you turned your mic off, buddy.
I think on the latter, one of the challenges that you have is that this is not an RIA. An RIA is a registered investment advisor. You know why it's not an RIA? Because Bitcoin's a commodity. And so I think that they're kind of ignoring the law. And we dealt with this with the rest of the DATs. If they were stacking a bunch of securities, they would be an investment advisor. They're not. And that's the law of the land. And so I have an issue with it. Look, they're a commercial entity. They can do what they feel like doing. Being in passive indexes should be, not the end all be all, but it's really nice for price action if you can get your DAT in there. Look, I think the entire DAT complex we should talk about a little bit as well. We're seeing a lot of pressure, negative MNAVs, stock prices have been hit. And I think there's been some really good dialogue around why and like what's the natural stasis of DATs. The fact is it's expensive to be a public company, especially post Sarbanes-Oxley. You got quarterly reporting. You have an entire set of compliance apparatus that you have to have in place so you can stay compliant with the law. And, a lot of history we have to blame for some of the things that have happened and why we need that type of compliance. I think in time you're going to see, Trump's even talked about moving from quarterly to semi-annual reporting, things like that to take some of the regulatory burden off. But TLDR, it's expensive to be public. That said, if a DAT is run efficiently, if they have control over their expenses, it's pretty simple math. What does it cost to run? And what is my yield? And what is my risk adjusted yield? Am I able to have profit from an operating company perspective? And I think as you get into like DATs, like the ETH DATs, they're generating that 3% and then some yield. If they can keep those earnings underneath the expenses, I think the natural stasis should be a positive MNAV. But the market's going to do what the market's going to do. And then, of course, if someone were to take over one of these bad boys and liquidate them, your MNAV should return pretty close to 1.
I'm very bearish on DATs. I think these are mostly in a death spiral. I think you should stay away. I think the market's going to force the holders to puke them out at terrible prices. The DATs have way too much structure on them to enable M&A, which is one way to unlock value. And the second way to unlock value is to sell the native token and buy back the stock, which also undermines their narrative. Markets know all of this too. So this is a terrible position to be in, I think, if you own DATs. Certainly stick to the highest quality DATs you can find.
Yeah.
Stick to the highest quality DATs. The vast majority of DATs are altcoins. And I don't think you've seen the bottom yet.
Oh, look, I'm not going to push back and say that a lot of DATs have some serious issues. Like we even talked about the lack of futures for some of these alt DATs. Like it's very hard to manage. Like, if you don't have all the tools at your disposal, it's very difficult. I do think that there's value, but again, it requires that fundamental underwrite, and you have to look at. There will be some phoenixes that rise out of the ashes, but there'll be plenty of ashes. Is how I look at it.
Yes, wait for the ashes. Wait for Rome to burn down, and then wait another 2 months because you're still probably too early. Then poke around, and then you might find something there.
I will remind everybody phoenixes are not guaranteed. Sometimes it's just ashes. But I guess I would say
everyone hates the DATs.
Everyone hates them. Well, let's zoom out on them for a minute. Like Matt Haugen had a very good thread on this, but I'm going to paraphrase it and say it relates to some of the things I have complained about with DATs, and I think, Ram, you've said before as well, which is, let's think about DATs and valuation. One, if you had a DAT that you knew with certainty was liquidating basically tomorrow, it should trade exactly at the value of its underlying assets, right? Plus or minus some wiggle for selling that thing, but that's an execution question at that point. They don't. Why? On the bad side of the ledger, Matt says expenses, illiquidity, and what I'm going to file under corporate risk, aka idiosyncratic risk, aka Chris is the director and he turns out to be a North Korean and he stole half the money type stuff. Back to why do we have Sarbanes-Oxley in the first place? Right. So all of those are completely valid reasons for a DAT to trade below par. Expenses in particular for many of these DATs, as Ram said, are very high. There are some that have promised, quite frankly, some egregious compensation packages to people, and so as a result should be trading at a large discount. So Matt's reasons for trading above par, and here's where I'm really going to lean into the Ram bit, were debt issuance so that they could have cheap funding, the ability to lend assets, and income generating strategies with derivatives. And let me tell people this, all three of those are reasons for them to also trade negative. If you look at the leaders of most DATs, you do not have like experienced bank and hedge fund executives doing this 80 hours a week with the kind of track record where you think they know what the hell they're doing in that space. It is Chris, myself, and Ram can all tell you, banks are like a combat sport. Like you are playing against other people. This is a competitive field. If you think you can just get into lending and magically make a profit, or get into derivatives trading and magically make a profit without paying a lot to hire good people and building a whole bunch of stuff that itself is really fucking expensive, you are like on another plane of existence. So I actually look at most dads trying to do that and be like, nope, they're going to blow themselves up.
Amen. Like, I think you made a great point at the end. Operating company matters, right? And at some point, everyone's going to be some kind of a DAT in the future. If this thing that I think is going to happen called decentralized finance wins, like people are going to hold assets on their balance sheet. Maybe not, that's not going to be their primary objective, but you're going to see this convergence happening, and operating companies matter. Profitability matters. I've talked to many DATs in the last week, some really good ones. Their entire focus, operating company. Hey, I see this gap in my ecosystem. I'm going to close it. I'm going to go out and I'm going to lead enterprise sales. I'm going to leverage the power of U.S. capital markets to really build out an incredible team. Maybe I'll make an acquisition in this space. I'm going to own the operating company. On debt, I'm so glad you brought this up. I've been thinking about it forever. I think structured correctly, you could have a new type of debt, in-kind debt, where you actually offer total return products. And you could actually make that part of your operating company, because if you know what you're doing in the DeFi space, you can probably earn more and take a spread on the coupon that you have to pay. Take Ethereum, for example. It's almost impossible for a sovereign wealth fund or anybody else to buy a security that pays you total return Ethereum, pure total return ETH. You can buy the ETF. It's really hard to stake because you have to hold contingent liquidity because of the unbonding issue, which has got out of control because we had an issue. But what if you were to issue, take in-kind ETH, stake it, make a spread, pay back a competitive rate? If that math works, you can actually make money and you can offer the world something that they want, a total return security. Am I wrong?
No, I think that one makes sense. And the other thing that I would say is, Chris, I think you've hit on something important about the debt conversation too, which is the type of debt that you take on really, really matters. So if you look at MicroStrategy, the mistake that they've potentially made is like term debt with fixed coupons as things are like flopping around like dead fish, and then went and acquired more Bitcoin denominated assets on the back of dollar denominated debt, meaning that you've got essentially an FX trade going on inside of that.
100%.
Right. Chris, you're familiar with FX. It's more volatile than people think. When you put Bitcoin on the other side, boy, are things going to get spicy. And that's just Bitcoin, like alts, even worse. On the other hand, if the data DAT used was something like, say, repo, right, where you're just essentially, using your Bitcoin or something, lending it out and collecting something in return, or doing the reverse, like borrowing dollars against it, and then Chris, as you said, deploying into DeFi and earning higher spreads than like the regulated financial entities could, there might be something there. But the important part of all of that is that you are currency and like term matched on both sides.
Yeah, like there's more to it, right, Austin? Because many times you're going to have dollar liabilities, right?
Yes.
You're going to have to pay people in many cases. Yeah, you can buy NFTs with ETH, but you still have those dollar liabilities. You need stable coins. Like people want dollars. They're not going to. Many cases, they're not going to take your Bitcoin or ETH, or not yet. And so that mismatch has to be really carefully managed. Personally, I I don't think it's going to be the end of the world for some DATs to sell in kind, because like if you're a monster ETH DAT and you're making nearly 100% of your revenue, and again, I'm overgeneralizing, in staking, let's just say, and I don't think that's going to be a successful formula. I think they're going to have other operating companies, but if all of your revenue is in ETH and your liabilities are in dollars, yeah, maybe you can lend it out. But look, at the end of the day, that's that mismatch. That's going to be one of the tricks in managing a DAT, is that mismatch.
Yeah, I mean, I concur with everything. Like, that is just adding to the beta. The beta is going in the wrong direction. That's it. These are attention momentum assets. The attention's moving to Nvidia, Tesla FSD, Google Gemini 3, everywhere else. And I think that'll continue to outrun.
For now. And like, but the fundamentals are like it. But Rom, look, if you can build fundamentals and you have an operating company that's profitable, like that's the solution here, isn't it? You got to earn your way out.
I mean, 3 to 5, like your ETH point is like right on the mark. Like I think it's accurate. However, you got to generate so much. We got 40% EPS growth at Meta. We got 60% revenue growth at Nvidia. Like the core generating power isn't there to at the current prices.
Yeah.
Right.
And exactly until ETH rocks back to 60K, like Tom Lee's telling us it's going to do, and then it's going to be just fine because they're stacking crypto to share.
Every cycle, someone gets carried out in a stretcher. Is this Tom Lee's time? Right? I don't know.
No. I talked to him this morning. He's going to be fine.
Yeah. Is it Michael Saylor's time?
Ooh.
I would tell you I'm more worried about. I'm more worried about them given the debt structure. That's not a statement on Saylor. That is a statement on when you take on fixed debt against a highly volatile asset. Historically, that ends pretty fucking badly.
Yeah. The thing about the debt is that, like, even if you did overnight funding, if you can't roll over your debt due to some kind of seizing in markets, you have an issue there, which is another issue we saw in the 2008 crisis, right?
Well, we saw that when it was matched against longer dated stuff. So like, let me propose a theoretical DAT structure that I actually think would stand the test of the current moment, which is, let's say I have a DAT that has a huge pile of Bitcoin or ETH. I go borrow against that and just deploy it into the basis trade, right? I'm earning a spread on that thing. So I'm generating positive cash flows into my vehicle. And because I can unwind the basis trade spot and my borrowing is spot, I'm term matched on those things. Then exactly as Chris said, you got to take those and start buying more things that generate cash flow. That's kind of like, call it like DAT Berkshire. That I think could work. But like anybody doing term here, like guys, look out. You don't do term on a 60% fall asset.
It's a great point. Look, I think this, go ahead. Sorry.
No, the alts can't do that basis trade, a regulated basis trade with futures, right? Because they don't exist, except for
the DATs can.
No, they can't. There are none. That's my point. It's like there are no, like we're just really hamstrung right now. We don't. I think they're coming online, but we don't have.
No. I'm saying have your DAT should do this like offshore, just like do it with Athena or something like that. Like there are ways to get into the basis trade.
Keep it regulated, man.
I was going to say I'm making you angry now. I'm just saying if you want to take that risk, you totally could.
The consequence of all of this, I would say, is number one, DATs will be sold on rallies. People, they're in quicksand. They're trying to keep their head above water, or above the sand, I suppose. The second thing is you will see puking.